Let me say something that's going to make a lot of people uncomfortable. You've been lied to. Not by your broker, not by a scammer, by the internet, by the algorithm, by every finance bro on social media who told you, just buy SCHD, bro, it's passive income, bro, you're gonna be rich, bro. SCHD, the Schwab US Dividend Equity ETF. $84 billion in assets under management, over 101 holdings, thousands of five-star reviews from people who bought it and never once opened the hood. And that, right there, is what I call the dangerous illusion of being rich. Here's what the illusion looks like. You buy SCHD, you see that ticker go up a little, you see a dividend land in your account every quarter. Your brain goes, yes, I am an investor now. I am building wealth. I am different from the others. But what you're actually doing, you're buying a package deal, a gift basket wrapped in a bow, and nobody told you that some of the fruit inside is already rotting. Think about it like buying a rental property. You don't just look at the address and write a check. You look at the roof, the plumbing, the foundation. You do an inspection. Buying any ETF without looking at its underlying holdings is like buying that rental property sight unseen and then wondering why you're not cash flowing. Today, we are doing a full inspection on SCHD. We're going to pull back the curtain on the actual top 10 holdings with real dividend yields and real payout ratios. And I'm going to show you exactly which ones are a fortress and which ones are a financial time bomb. By the end of this video, you are going to understand SCHD in a way that 95% of investors who own it never will. Stay with me. This is going to change how you invest forever. Okay, let's talk about the single biggest mistake that middle-class investors make. And I'm calling it out today because I was this person. It is called yield chasing. Your brain sees a dividend yield of 6%, and it lights up. Dopamine, excitement. It whispers, that's free money. I want that. I need that. This is your brain on bad financial education. Your brain is broke. Because here's what your brain is not asking. It's not asking, how is this company actually affording to pay me that dividend? That question, that simple, brutal question, is the difference between building generational wealth and sitting in what I call the invisible prison. A prison of dying companies that keep paying you just enough to keep you quiet while their actual businesses slowly erode around you. Let me introduce you to the most important number you're probably ignoring, the yield ratio. Here's the definition. It's the percentage of a company's earnings it pays out as dividends. A 40% payout ratio? Beautiful. The company earns $1, keeps 60 cents for growth, pays you 40 cents. A 75% payout ratio? Okay, a little tight, but manageable. 100% payout ratio? That means the company is paying you every single dollar it earns. There is zero room for error, zero room for reinvestment, zero buffer for a bad quarter. Here's the analogy I want you to tattoo into your brain. Imagine a family. They take home $10,000 a month. Their mortgage alone costs $9,500 every single month. They look fine on the outside, nice car, nice clothes, but they are one emergency away from collapse, one hospital bill, one job loss, one bad month. That family is a 95% payout ratio company. And here's the brutal truth. Some of the most popular dividend stocks sitting inside your beloved SCHD right now, are that family. Most financial advisors will never show you this. They sell you the ticker. They don't show you what's inside the ticker. We are about to fix that. All right, let's do this. As of March 2026, the top 10 holdings of SCHD make up over 42% of the entire fund. That means almost half your money goes into just these 10 companies. Let me read them off with their actual numbers. Real yields, real payout ratios, pulled from live financial data. Okay, take a breath. Let's break this down. I'm sorting these 10 companies into two buckets. Conoco P. Phillips, COP. Payout ratio around 45%. This is your rock star. A 45% payout ratio on an energy company, that is financial discipline. COP earns the cash, keeps half of it to reinvest in the business, and still pays you a growing dividend. This is what responsible income investing looks like. Even in a down oil cycle, there's a massive buffer before the dividend is threatened. Merck, M-I-R-K, payout ratio around 43%, a pharmaceutical fortress. Merck is generating serious cash flow. The pipeline is strong, the payout ratio is well under control, and when a pharma company commits to a dividend with a 43% payout, you know they have the earnings durability to back it up. Keytruda alone is a cash machine, safe, well controlled. Lockheed Martin, LMT, payout ratio around 64%. Defense never goes out of style. Defense spending is about as recession-proof as it gets. Lockheed's contracts with the U.S. government stretch out years. The payout ratio is healthy. The dividend growth is consistent. It's not flashy, but flashy doesn't pay your bills in retirement. Coca-Cola, KOCO, payout ratio around 68%, a 62-year dividend growth machine. Coke has raised its dividend for over 62 consecutive years. The payout ratio sits around 68%, which is manageable for a consumer staple with the brand moat of the Coca-Cola Company. Yes, the yield isn't exciting at 2.7%, but when you're holding this in a portfolio for 30 years, you don't want exciting, you want reliable. Bristol-Myers Squibb, BMYP, payout ratio around 73%, borderline but manageable. Okay, BMY is the one I'd be watching most closely in this safe bucket. A 73% payout ratio is not catastrophic, but it has limited headroom. BMY has significant patent cliffs ahead for some key drugs. If earnings disappoint, that ratio moves into the red zone fast. Still in the safe bucket for now, but it's a hold and watch situation. Amgen, AMGN, payout ratio around 72%, biotech powerhouse with growing income. Amgen's payout ratio is around 68 to 72%, and the company has been aggressively growing its dividend, roughly 10% annual dividend growth over 5 years. Strong biotech pipeline, solid cash flows. A keeper. Verizon, VZ, payout ratio around 68%, high yield with a debt asterisk. Verizon's yield of over 5.4% is genuinely juicy, and the payout ratio at 68% is technically fine. But a big but, Verizon is carrying a massive debt load for its 5G build-out. We're talking over $130 billion in long-term debt. The dividend is covered today, but if rates stay higher for longer, that debt becomes a slow-moving anchor. It earns a place in the safe haven bucket, but just barely. Watch the debt story closely. Here's where it gets real. Chevron, CHMEX, payout ratio around 107%, paying out more than it earns. Let me say that slowly. Chevron's payout ratio is 100%. They're paying their shareholders more in dividends than they are currently earning in profit. How is this possible? They're funding part of the dividend from reserves and borrowings. This is financially sustainable only if oil prices recover and earnings bounce back. But if oil prices stay suppressed, if margins tighten, that dividend is vulnerable. CVX has a long history of defending their dividend. They're a dividend aristocrat. But right now, the math doesn't lie. This is a flashing yellow light. Not yet red, but you need to keep your eyes on it. Altria, MO, payout ratio 101%, a 6.3% yield on a declining business. Altria is the company that sells cigarettes, Marlboro. And yes, that 6.3% yield looks incredibly attractive on paper. But here's the brutal math. Altria's payout ratio is 100%. Cigarette volumes have been declining for years, roughly 4 to 5% per year. The company knows this. Their own stated target is an 80% payout ratio, which tells you they're already stretching to maintain it. The only reason Altria can keep paying is because the tobacco business, even as it shrinks, generates enormous cash flow, and they have a stake in Anheuser-Busch InBev. But you are buying a declining asset and hoping the cash flow holds long enough to justify the yield. That is not investing, that is praying. PepsiCo, PEP, payout ratio around 95%, the most surprising name on this list. People hear PepsiCo and they think blue chip, safe, stable. And they're right, but the payout ratio tells a different story right now. PEP's TTM earnings payout is around 95%. Their free cash flow payout ratio, 100%. Pepsi has been dealing with cost pressures, volume declines in some markets, and a consumer that's pushed back against price hikes. The yield of 3.4% sounds reasonable, but when a company is paying out almost everything it earns while also trying to invest in its business, something has to give. Either earnings recover or the dividend growth stalls. This is a watch list company in 2026. There is something else lurking in your portfolio that nobody's talking about. It's called inflation, and I call it the silent killer. Here's the scenario. You're sitting in 2026 with a portfolio generating a 4% yield. Feels great, looks great on paper, but inflation is running at 3.5%. Your real return is about 0.5%. You're barely treading water. And if that 4% yield isn't growing, if the company is freezing dividends just to maintain that number, you're being eaten alive. That's the difference between a static yield trap and a dividend growth machine. Think about compound interest. Einstein called it the eighth wonder of the world. But the version that most people ignore is dividend compounding. It's not just about what you're earning today. It's about the trajectory of what you'll be earning in 5, 10, 20 years. This is what I call the snowball effect, and the only way to activate it is to own companies that are growing their dividends, not just maintaining dangerously high ones. Let's go back to our top 10. Who is growing their dividend aggressively? ConocoPhillips has been growing its ordinary plus variable dividends, flexible and expanding. Merck has been growing its dividend consistently, and at a 43% payout, they have tons of room to keep doing it. Amgen has been growing at roughly 10% per year for the last 5 years. That snowball is already rolling. Lockheed Martin has a multi-year track record of consistent raises. Defense contracts equal reliable cash flow equal reliable growth. And who is barely keeping their head above water? Altria, Chevron, PepsiCo. Altria can't grow the dividend aggressively without blowing past a 100% payout. Chevron is already over 100%. PepsiCo's free cash flow is stretched. Here's the cold truth. A 3% yield that grows at 10% a year will outpay a 6% static yield within 10 to 12 years, and it will do so while the underlying business is getting stronger, not weaker. That is the snowball effect. That is how you invested the right way. All right, let's land the plane. Final verdict. Is SCHD still worth buying in 2026? Yes, but not blindly. Here's the nuance that most people miss. SCHD as a total package is still a legitimate, high-quality dividend ETF. The screening methodology, which requires companies to have 10 consecutive years of dividends, strong cash flow ratios, and high relative yield, means the fund naturally filters out most garbage. But filtering out most garbage is not the same as filtering out all garbage. And right now, in 2026, approximately 3 of your top 10 holdings are flashing warning signs on payout ratios. CVX at 100% payout, MO at 101%, PepsiCo at 95% on trailing earnings, over 100% on free cash flow. Together, those 3 companies represent nearly 12.5% of your entire SCHD position. This is why I want you to build what I call a shadow portfolio. A shadow portfolio is not about replacing SCHD. It's about complementing it. It's about knowing the math so well that you can overweight the safe havens and underweight or outright avoid the yield traps. Here's what that looks like in practice. Step 1. Keep your SCHD core. Don't blow up your strategy. Dollar cost average, reinvest dividends. That part is fine. Step 2. Build individual positions in the safe haven names: COP, MRK, LMT, KO, AMGN. These are companies you can confidently own more of because the math supports dividend growth, not just dividend maintenance. Step 3. Monitor your yellow flag names quarterly. CVX, MO, and Pepsi aren't sell signals yet, but you should be watching their earnings. If CVX's oil revenues don't recover and the payout stays over 100%, that's a conversation. If MO's volumes decline faster than expected, same thing. The whole game here is about wealth without burnout. I don't want you grinding for 40 years and then landing in a portfolio of zombie dividend companies that pay you just enough to keep you trapped. I want your money doing the heavy lifting, safely, intelligently, based on math, not hope. You now know something that most SCHD investors will never bother to learn. You know the payout ratios of all 10 top holdings. You know who's a fortress and who's a time bomb. You know that a 6% yield on a declining business is not passive income. It's a slow-motion tax on your future. That knowledge is power, and power is what separates the middle class from the wealthy. Stop making blind middle-class mistakes. Stop falling for the dangerous illusion. Start building a bulletproof shadow portfolio based on real math, not hype, not yield chasing, not social media bro advice. If this video just saved you from a dividend trap, hit subscribe. Drop the name of your most watched dividend ETF in the comments, and I'll do a full payout ratio breakdown of whatever you throw at me. The math never lies. Let's use it together.